All right, so Brian, thanks for jumping on. I know you've got a background that I think is genuinely rare, right, in the space when it comes to attorneys and then even tax attorneys. You're Georgetown LL.M in tax, Big Four training at Ernst and Young, super lawyers, 11 years running, admitted to the U.S. Supreme Court. And rather than listing, credentials, just kind of give people a quick picture of who you are, what you focus on, and kind of how you got here.
Yeah, absolutely. Thanks for having me on this morning, Mark. So I'm a partner at a law firm in Nashville, Tennessee called Thompson Burton, and I am, the lead tax partner there. I've got another partner that works with me, Eric Burton. I'm sure you're going to meet him. And we focus on all things tax, whether it's a tax controversy, mergers and acquisitions, estate planning, um, structure work for clients, and mostly we deal with high net worth and ultra high net worth individuals and businesses that want to make their lives a little bit easier from a tax standpoint, whether that's positioning them to sell to private equity or just doing a mergers and acquisition deal, whether that's a sale or a purchase. That's what I do on a daily basis. In fact, I'm in the middle of a $120 million transaction right now where we are selling a whiskey distillery here in Tennessee through a receivership that is eventually going to go into bankruptcy. So we do really complex work. And the reason we do this and what we focus on is Eric and myself, and I know I'm talking about Eric a little bit here, but we really are a team. So I focus on the structure, I focus on the income tax, I focus on things like that. Eric focuses on estate planning. Not that we can't interchange with each other, but those are just the lanes we've chosen. And, like you said, I graduated from Georgetown. I was recruited out of my class to go work for Ernst and Young, which was a great opportunity. And I did that for a while. Then I jumped into the legal world and yeah, I that's what I do. I do mergers and acquisitions and I do tax profiling and all things tax. So it's fun. I think of it as a puzzle. Every day I'm putting a puzzle together. So, the goal is to help people out. The goal is to reduce taxes, and the goal is, for many cases, to provide people an exit into financial freedom.
Yeah, wonderfully said. I mean, because most people's relationship with tax professionals kind of starts and ends when things go wrong, right? Or maybe for some at filing, right? If they're working with a tax professional at the attorney level. But you're doing something very different, right? It's this proactive planning. There's complexity here. So, what's the actual difference from your view between tax compliance and tax strategy? And why does that distinction matter so much for someone at higher net worth or income levels?
Well, yeah, that's a great question, and often people ask, "Well, why did my CPA not tell me that?" And we couch that in this way that CPAs, certified public accountants, are trained to comply with the tax code, to check the boxes, to put the right things in the right boxes, so your tax return gets accepted, and so on and so forth. As a lawyer and a strategist, what we do is we work with that CPA. So when those numbers have to go in the boxes, it's more beneficial to you. And it's an ongoing relationship. We have to meet at least once a quarter. And in that meeting, we talk about what's going on in your life. Have things changed? What are you looking to do? What have you done? And then we organize your year in such a way that we're not rushing in the fourth quarter of every year to try to come up with deductions. We're doing it throughout the year for you. Now, deductions aren't the only way to reduce your tax profile. There's planning, and we plan with people, whether that's estate planning, business planning, succession planning, whatever it is, We need to get in front of it now. So later on down the road, there isn't some massive tax bill. There's nothing worse than talking to your CPA around October 10th and they're like, oh, you're going to owe $250,000. Get ready to write that check. And then you're sitting there like mouth agape going, why didn't you tell me this? Why didn't we do some things along the way to reduce that? And typically, what you hear from that tax preparer is, well, we can do that next year. And, I just need you to read over this tax return, sign off on it, and send it in. Do you know how many conversations I personally have had like that with my own CPA? And that was early on in my career. And finally, I was just like, you know what? Nobody's going to do it for me. I'm just going to do it. I've got the background, I've got the experience, so I do it. So I structure my entire life that way. Every month, every week, every day, whether I'm going to lunch, I'm keeping the receipts, whether I'm buying something for my practice, I keep those receipts, whether it's in my real estate practice or my tax practice. My wife and I have real estate, and so it's very important that we keep those books in order. So at the end of the year, we're not scrambling for deductions to offset our income. And so many people have to scramble, and I hate that. It's such a hole in the tax planning world, especially when you have high net worth individuals that are working really hard every day, whether it's a doctor, a lawyer, a CPA, an architect, a business owner. They're all working really hard to make this money, and they need their team to say, hey, let's do it this way. So in the fourth quarter, you're not stroking a big check. And that's what we do. And that's why we do it. But the planning aspect of this versus the compliance aspect is such that, yes, lawyers know the law, we know the compliance rules, and we are working within those. Whereas a CPA or your basic tax preparer, they're not. They're just compliance. They are putting the numbers in the box. Whereas the lawyers and what we do here at Wealthguard and at my own law firm at Thompson Burton, we're planning for those numbers, whether it's increasing those numbers or reducing those numbers. We are on the front end of this almost as a prophylactic against the tax man because he does cometh.
Absolutely. And you bring up a good point in my background and the SEAL teams, right? We had a saying, plan your dive, dive your plan, right? If you don't have a plan, you're just leaving it up to too much circumstance and chance, and you're always behind the curve playing catch up, right? And it speaks to the fact that oftentimes in the tax planning world, people are going to a specialist here and a specialist there. They don't really talk, right? The difference here is we're working together, right? Estate attorneys, CPAs, financial advisors to work from a common plan, right? So, in your experience, what happens when those people are operating in silos and what becomes possible when they're actually working together on a coordinated effort?
That's a great point. I had a conversation yesterday with some potential clients, and they're doing very well. They're in East Tennessee, and they're running a senior home care business, and those guys are crushing it. And one of their questions was, hey, we have a CPA we really like and a financial advisor we really like. Are you going to work with them? And I was like, well, of course we'll work with them. We're not looking to take the place of any professional that you're very comfortable with because the trust has already been built. We are simply looking to support and augment. That's all we're looking to do. Now, if you don't have a team, hey, we'll put a team together for you. But if you already have pieces of that team, it's so much easier for me to pick up the phone, call your CPA, call your financial advisor, call your bookkeeper and say, "Hey, let's get on a call. We all need to get on the same page. Here's what we're going to do. I need to show you guys the plan and you give me input so we can tweak this plan as you see it from your perspective." So we all have a role, but we do better when we act as a unit as opposed to, you know, individual cowboys going out there doing whatever. And then, for example, Eric and I, then we were like, well, okay, they did this. How are we going to undo that to take care of this other problem over here? So, what we like to do at Thompson Burton and through Wealthguard is, hey, we'll call your CPA. Let's get on a call. Let's tell them our ideas. Let's tell them why, and let's give them the authority from the tax code and from the case law out there to do this and show them what we think it's going to look like. Because we do model out these ideas. We provide tax plans, we run spreadsheets, we run illustrations. We do all of that for the client so they can show it to their CPA, show it to your financial advisor, show it to your estate planning attorney because that is so necessary for what we do. It is very hard, just like you said, to plan your dive and dive your plan if there's no plan. So, what we're doing here at WealthGuard is we are creating the plan and saying, hey, take your plan to your CPA. If they have questions, let's get on a call. Let's all get on a call and let's figure this out. So, that's how we approach it. We try to break those silos down and have open and clear communication with your professionals because they are your team and everybody needs a team. You can't go through this life alone.
100%. The plan is the most important piece in one of, the most serious aspects of life next to death being taxes. There's very little planning across the board for most people unless they intentionally step into a collaborative environment where that's front and center, where that's the prioritized, right? So one concept that I find seems to keep people from having a real plan in place separate from, ones who just have like a good CPA is the idea of how income is characterized, how money flows through the right structure. Can you kind of break that down plainly and explain why getting that right is one of the highest
Yeah,
leverage
so
things to
whenever
do?
we meet with a client, there are a lot of things that we have to take into consideration. And it starts at the 1040. That is their personal income tax. And what we're doing is we're deconstructing it. What is informing your 1040 tax return? And then we build it out from, okay, well, this money came from this business or came from this trust or this inheritance. And so we're putting it all together in such a way that if you just put all those numbers on your tax return, yes, you're going to owe tax on that for the most part. Now, you spoke about income characterization. Yes, there's active and there's passive. So, what we try to do is take your active and your passive revenue streams, coordinate them in such a way that you're getting the most bang for your buck from all these revenue streams. Whether it's your W 2 or your business income, or maybe you have a passive business out there that is just kicking in money every month. For example, real estate. Real estate is a great way to offset income tax because if you can qualify for active status or be a real estate professional, then we can offset a lot of W 2 income. A lot of people don't know that, but there are very strict rules around it. So you have to follow those rules. For example, under Section 469C7, you have to have 750 hours a year. You have to spend more than 50% of your time working in real estate. And then you unlock these deductions that will offset your W 2 income. It's a great way to utilize the structure theory that we have. And so, what we'll do is we will create like a holding company at the top that will then flow down into multiple entities. And through those entities, which the holding company owns, we move money up into the holding company and out to you as the individual. But along the way, we're picking up deductions by doing that. And that reduces your tax income. So what we, or I mean, that reduces your taxable income. So what we're trying to do is make you cash positive but tax negative. Now, there's a difference between a permanent deduction and a deferral. And so a lot of the deductions you get out of real estate, such as depreciation, is going to be recaptured. So we're planning for that on the front end while you're getting the benefit of it now. And by planning for it now, we can create an exit for you in 3, 5, 7, 9, 10, 12 years out that you know, okay, even though I'm getting all these deductions now and I'm making good money, when I exit out, I'm not going to get hit with a massive tax bill. So those are the kinds of things that we are thinking about. And the reason we're doing it for these people, whether it's choosing an S corporation or an LLC or a special purpose entity or a holding company or a C corporation. C corporations have their place in what we do. A lot of people are like, why would you have a C corporation? Well, we would have a C corporation because of Section 1202, which is the qualified small business stock election that you can make when you create a company. It gives you $15 million tax free from capital gains if you hold that stock for 5 years. So we are taking into consideration all these things when we're designing this up front, because, like I just said about the 1202, you have to hold it for 5 years. So there's a lot of planning going on. And in that 5 year period, things change. And so we have to be able to have a structure that is flexible enough, but also efficient enough to make it worth your while.
Absolutely. And it's I'm glad you touched on real estate because you're not only a tax attorney who advises on real estate, you're a real estate investor yourself, and you also wrote a book on it, right? So I think you did a pretty good job covering that, but what do you feel people fundamentally misunderstand about how real estate actually works from a tax standpoint?
Again, another salient question to what we're talking about. I had a phone call yesterday with a young lady who quit her corporate job to go into real estate full time. And she's like, tell me what I don't know. I'm like, well, I don't know what you don't know, but I'll tell you what I know. And it was about structuring. She's like, how do we do this? Do I buy it in my individual name or do I buy it in LLC? And she's like, why do I need an LLC if I have insurance? And I was explaining limited liability, and you're you're capturing your liability and you're segregating it away from um, your personal life, whether that's your retirement account, your personal house, you know, your savings, your checking account, because a lot of people have kids and they're married, and you don't want to put any of that at risk by getting into real estate. So these are questions that are very important, and a lot of people just don't know what to ask when they're getting into real estate. They don't know what areas of real estate to get into because people think of real estate as, oh, I've got a rental property. Well, there's so much more to real estate than that. There's self-storage, there's oil and gas leases, there's long-term, short-term, multifamily, single family. There's trailer parks, RV parks, anything you can really think about in the world of real estate. That world is enormous, and there's a place for everybody in real estate. But it's important when we speak to our clients to ask them, one, do you have the stomach for it? And we'll walk through those questions. It can be time consuming. It can be frustrating at times. It can be bizarre because you get called with people doing things that you're like, how did that happen? Like, if you have to go replace an entire toilet that you just put in, well, a kid broke a toilet. He dropped his favorite toy down the toilet and it cracked the porcelain. So there you have it. You're like, okay, well, these are just things you deal with all the time. And a lot of people aren't ready for it because, for the most part, our clients aren't dealing with that kind of stuff because they've been making all this money over here. So when you get into the real estate world, you're actually getting into the people world, especially when it comes to rental real estate. Now, self-storage, oil and gas, that kind of component of real estate is very different. But when you're in residential renting real estate, yeah, you're dealing with people every day. And so you have to have some people skills.
Absolutely.
But the benefits derived from real estate, there is no better vehicle for wealth growth, deductions, and planning. 85% of all millionaires in the United States have some relationship with real estate, period.
That's huge. Yeah.
Yeah. So we are, we're not recreating the wheel. We're just advertising that, hey, this is actually a really good method. Let's marry it to what you're already doing and let me show you how it can help. It is a fabulous tool and it's a wealth grower. It really is. It can create generational wealth.
Absolutely. And in talking about planning, right, there's also a version of tax strategy that gets people into trouble, right? Too aggressive, poorly documented, can't survive a question from the IRS when put under scrutiny. And then there's the version that's sophisticated, defensible, and compounds over time. So, how do you think about that line?
Yeah. So people will see things on social media. And look, I'm on social media as well, but you have to be careful about what you see and what you hear. Every time I put out a video or content, I have to be right. I'm a lawyer, I have a law license, I have law licenses. I have to be right because I'm trying to inform people to educate them. So many people just act like it's the Wild West on social media, and you're getting all that passing through to people, and suddenly they hear it enough and they believe, oh, well, this must be true. No, it's not true. I was watching something the other day. I was watching an interview on social media, and this guy was like, "Well, no, I didn't report taxes on it. I just got paid through Venmo and Cash App." And he's like, "Why would I report that?" Well, you have to report that because that's income. That's income. You can't not report that. That's tax evasion. And if you file a tax return on it, that's tax fraud. So many people just believe what they see and think, oh, well, this is the right way to do it. Especially in this day and age where it's so easy to move money back and forth, whether it's through cryptocurrency or Venmo or Cash App or, you know, any of those types of online money movement mechanisms. That is very dangerous for people. So we have to, on the front end, educate and then show them the right way to do this.
Absolutely. It's huge. And yeah, I can't, it's countless times where people come in with either a strategy or something that they've paid $40,000 for offshore. And, it's like there's so much information out there. Um, in your opinion, right, someone who's watching this and wondering whether any of this is relevant to their situation, right? What are the markers? Who actually needs to be having this conversation and who's probably not at a stage where it really makes sense yet?
Okay, well, let's start with who's at a stage where it doesn't make sense. Somebody early in their career, like a W-2 earner, early in their career, probably making less than $200,000, single. This isn't really going to help you. Like, there's very little we can do, even at the margins, to bring that tax rate down. But if you're above 200, say 250 and above, and you're married, a little bit more established in your career, that's where we find the sweet spot. For example, a married couple, you have a high income earning spouse, and maybe you have a stay-at-home mom or stay-at-home dad. We can utilize that stay-at-home mom or stay-at-home dad to create an avenue into a tax structure that will offset your tax profile by creating other businesses that flow through. That way, we're getting deductions coming through that business, whether that's a defined benefit plan, whether it's depreciation, whether it's a SEP, a simple, an IRA, anything we can do to draw down that tax profile to bring the adjusted gross income down. Now, that doesn't mean you're losing that money. It just means we're moving it in different places. For example, if you have a high earning W-2 individual and a stay-at-home spouse, the stay-at-home spouse creates an LLC with that W-2 earner, and they are now partners in a business. That's great. That business generates income. That income we can then roll through um, that structure in such a way that the expenses along the way are offsetting that income, that W-2 income. And that company over there will probably need things like needs a vehicle, it needs a phone, it needs a computer, it needs a retirement account. Those are things that are really informing this W-2's tax profile. And by doing that and marrying those together, we can really reduce that tax. Now, by reducing the tax, that doesn't mean you're losing money somewhere. That means we're trying to create greater cash flow in your life, but make you tax negative over here. And that's one of the things that we have seen working with our clients, even Wealthguard, that if we get the right situation and we have somebody that will open their mind to what we can do, if you just work with us, it's really a game changer. So, you know, it's fun. I enjoy doing it. I enjoy showing people like if we do this and it's only going to take X amount of hours a week, do you think your spouse would do that? And they're like, well, yeah. I'm like, well, then let's talk about that. Whether that's the short-term rental loophole, that's real estate professional status, or that's opening another business that, for example, my wife right now is pushing me really hard to open up another business. Um, she wants to do monogramming and high-end wedding gifts and party gifts. And I was like, okay, well, the capital outlay for that would be substantial, but at the back end of that, I look at it, I'm like, it's not a bad idea. It creates more deductions in our life as long as we can cash flow it and it makes some money, makes some sort of profit. It could be a game changer in our own tax profile. So it's something I'm thinking about. So that's an example of, a W-2 earner, which my wife is, and myself, who I'm not a W-2 earner, creating a structure that will inform our tax profile to offset our tax liability.
Yeah, it's huge. And again, it just speaks to proper planning, right? If you don't plan for that, it's not going to magically happen or fall into place, right? And if you don't have a team putting it together, unless you're an expert in it or you have the experience to draw from, it's not going to happen as well. So, last one here, but someone watching this has been meaning to look into it, get their tax situation optimized for a couple years. They know something's not working as efficiently as it could be. What would you want them to walk away thinking about after this conversation, and when's the best time to start? Because, taxes are always like a headache in people's minds that they want to avoid until the last possible moment.
Yeah, so if anybody's seeing this video, what I would recommend to you before you even pick up the phone to call us is take a look at your tax returns. Just pull out the last 3 years and look how much you paid. What if we could get you half of that back? Could you use that somewhere in your life now? Could you put a kid through college? Could you buy that car you need? Could you buy that second home that you've been dying for years? Yeah, possibly. Now, once you look at that, you then need to reflect. Okay, I make this money here. If I set something up over here, do I have time for it? Can I do it? Can my spouse do it? And if the answer is yes, give us a call. We are more than happy to work with you. But if you're a business owner, if you are an entrepreneur, if you own a business, definitely give us a call, irrespective of what your tax return looks like. Give us a call. There's always something we can tweak, always. And I promise you, That phone call with Wealthguard will at least open up avenues that I can look at, Eric can look at, and we're like, look what they're not doing. Because I promise you, nobody has ever sat down with a business owner or even somebody filing just a 1040 after it's filed and said, okay, what can we do better? Why should we do this? And that's what we do. We even look at your current year after your tax return has been filed and say, oh, well, you didn't do this and you didn't do that. We can go back and amend that. We can take that deduction because you left it on the table. And we don't want to leave money on the table ever. So if you're watching this and you think this is for you, give us a call. We're more than happy to talk with you. Hey, you may not end up hiring us, but you may walk away from that phone call knowing a lot more than before the phone call. And that's what we try to do.
Couldn't have said it better myself, Brian. Thanks again for jumping on and sharing your wisdom here. Always a pleasure to sit down and have a discussion with you.
Absolutely, man. You have a great day.
All right, you too.
Bye.
Bye.